You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody. Welcome back to the Advisor's Option, the program here on the old Options Insider Radio Network, where we help you, the busy financial advisor and asset manager and fund manager, make sense of these crazy things we call options, how you could use them, some strategies, some overviews, as well as give you kind of an update of what's cooking, what's going on in the realm of options that may be of interest to you. We know you guys are busy, don't always have time to keep up with the latest updates, so hey, we're here to do that for you. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, ever-expanding Options Insider Radio Network. 13 programs on said network, soon to be 14, coming soon, but 13 for now. And where can you find all of those great programs? Well, of course, the easiest place, probably the mothership, the flagship, theoptionsinsider.com. Top left corner of the homepage, you'll see the Insider Radio Network tab. Right side of the homepage, you'll also see our Insider Radio Network call-out. So 2 places around the homepage for you guys to find it. Click on those overlays, and you can pretty much download, stream, whatever show you're interested in till your heart's content. Of course, you can always find us in all of the major podcast outlets, iTunes, TuneIn, Stitcher, AHA Mobile, and so on and so forth, even via our own mobile app available for iOS, Android, and the ever-exciting Fire OS. And of course, while you're listening, while you're downloading, while you're streaming, send us your questions, your comments. We love to hear from you guys. We got quite a few racked up for this episode. We'll see how many we can get to. We got a lot of content to cover first. And joining me to help me cover all that content, we got an extra special Swan episode this time. The boys at OIC are traveling hither and yon and couldn't join us. But I am joined, as always, by my co-host here on the Advisor's Option, the co-founder of Swan Global Investments, Mr. Randy Swan. Randy, welcome back to the program, sir.
It's great to be here. I just spent the last week in London, where it's cold and rainy and damp compared to sunny, shiny, and warm in Puerto Rico. It's quite a contrast.
You've been making quite the world tour lately. You were in Chicago a few weeks ago. You and I chatted there. Then London, now back to Puerto Rico. Anywhere else in between?
Nope. Nope, that's it for right now. Looking forward to the conference coming up this week. I know we're going to talk about that a little later, but getting everyone geared up for that.
Yeah, you guys got a big event coming up. We're going to get to that in a few minutes. But before we get to that, we are also joined another addition, a newcomer actually, from the land of Swan. He is Micah Wakefield. He is the Director of Research and Product Development over there at Swan. Micah, welcome to the program to you as well.
Thanks, Mark. Great to be here with you.
And Micah, since this is your first time joining us here on the Advisors Option, really quickly at the top of the show here, why don't you go ahead and give our listeners a bit of an overview of your background in the options and derivative space and what it is you actually do over there at Swan day to day.
Sure. Yeah, I actually came from the financial advisors space. I was working for an RIA in San Antonio for about 6 years before joining Swan a couple years ago. And my role there at that RIA was actually being involved in options. I was the director of trading and operations as well as a financial advisor. And one of my roles was also to assist any of our clients who were using options in their portfolios, as well as finding ways to take advantage of using options. So that was kind of how I ended up bumping into Swan and getting to know them and their strategy. And we were using their strategy with many of our clients. And so one thing I immediately noticed when I started studying and doing due diligence on Swan and their strategies was this was the type of thing that I was wanting to do on our clients' portfolios of using options within a portfolio to help structure returns in a better way for clients. So it was a great fit when they approached me on joining them here down in Puerto Rico as director of research. So my role includes basically helping with all kinds of things related with our trading and with our investment management team. Also in the writing of white papers, blog posts, and so forth, and any and all fun things related to analysis on our strategies and our investments. So it's great to be part of the Swan team. It's been a lot of fun so far.
And the rest, as they say, is history. Of course, we're not focused on history today. Our focus is in the here and the now, and indeed the future. So without further ado, let's dive right on into it with our The Buzz segment.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, like the man said, this is the portion of the show where we bring you some of the latest news and updates and happenings in the world of options as they pertain to you guys, the busy financial advisors, asset managers, fund managers, etc. We kind of break it down and distill it for you in an easily digestible format. And it's easy to choose what we're kicking things off with today, because if we're looking at what's coming up in the near future that is top of mind, that is kind of the big event in the world of advisor/fund managers and options, you know, where that Venn diagram intersects. It's pretty clear. The main thing right now is your big upcoming event, Randy, the Swan Global CIO Conference. It's kicking off this weekend, Sunday, actually, over there in your neck of the woods, the tropical Puerto Rico. I'm happy to say I'll be flying down there as well, so I get to check out this Puerto Rico you've been raving about to me for the better part of the last year or two here. I get to see it for myself. What's captivated you so much? But this is a conference that's kind of aimed directly at the audience of this program. You're kind of breaking down a lot of interesting developments and studies and research and all kinds of other interesting things that are of very much interest to our audience. So I think rather than me running it down for our listeners, why don't you go ahead and give our listeners a bit of an overview of what the event actually is, why you decided to go through all the trouble of actually having an event. I've done a few of these. I know how much work they are. So why you maybe decided to jump off that cliff, what your goals are for this, and what you're really planning with the eventer.
Well, big picture is our goal is to help educate and invite a lot of the people that we deal with on a daily basis and potential clients to really give them a much broader brushstroke of what Swan does, and obviously address and discuss and kick around the various problems and dilemmas that most investment advisors and institutional type firms have in today's environment, like the low interest rate environment. How are you coping with things like that? So the biggest goal is to be able to give access to the various members at Swan. I think we're probably going to have, I'm just guessing off the top of my head, probably around 7 or 8 individuals from Swan come down from various places around the U.S. to come down to Puerto Rico to really to really give access to a lot of clients as well as potential clients. So we obviously are very focused on the educational side, as we always are, and we talk about on this show, is we like to share our research and our results and what we think are the best solutions to the problems that I think we all face.
Yeah, I'm looking here at kind of the agenda, what you guys are planning on hitting on, and a lot of things that, I think a lot of participants in this space may find interesting. A lot of them probably don't get to hear. I hear some of this regulatory stuff at a lot of the other events I go to, because I go to a lot of industry-oriented events. But for a lot of active participants in this space on the fund manager advisory side, they don't have the opportunity or the time to do that. So I think kind of breaking all that down for them at this event will be useful. I know your first panel kind of giving an overview of the options industry as a whole and how the, shall we say, fluid structure out there in the realm of the options realm. We had 14 exchanges as of a few weeks ago. Then one exchange group gobbled up another. So now there are 6 under one umbrella. So who knows how many we'll have going forward, what kind of consolidation there will be, all the crazy mire of regulation that we're all dealing with these days. In fact, we'll get to some of that a little bit later in this very segment. Some of the restrictions out there and some of the trends. And that's just in the first panel. You've got a panel with different investment professionals out there talking a lot of things that are near and dear to this audience: due diligence, portfolio construction, asset allocation, a lot of things we talk about here on this program all the time, in addition to, of course, our favorite topic, risk management. You're going to have another chat with portfolio managers talking about kind of some of the things that they're dealing with right now, people, if they utilize options in some capacity, probably some of the roadblocks and obstacles and issues and benefits they're seeing in the space right now. This is always, whenever I talk to advisors and asset managers in this space, whenever they utilize some sort of derivatives component, there's always a few stumbling blocks and hurdles they have to overcome, whether it's the reticence of the client, whether it's some sort of restrictive covenant on behalf of the fund they're trying to invest with them or use their strategy or use their services, or maybe it's an intermediary, a fund advisor who's reticent or doesn't understand options, or maybe all of the above. There's a lot of roadblocks that have to be overcome when using these products. So I think an event like this really can help not just spread the gospel, as our friends at OIC like to say all the time, not just spread the gospel of options, but actually give these guys some actionable information that they could take back with them after they leave the sunny confines of Puerto Rico. Is that a pretty good overview of the event, or did I leave something out there, Andy?
No, absolutely. I think that's exactly right. We have a lot of sponsors in this event, so we gave those guys an opportunity to talk about what, obviously the firms like State Street and BlackRock, who we work with on a regular basis to handle some of the topics. Obviously, this is not all about Swan, but generally I would say it's really trying to bring a bunch of investment professionals together to really talk about the issues of the day and what we think are the best solutions.
So check it out, listeners. As we're recording this now, the event is probably about less than a week away, so probably hard for you guys to make it down to Puerto Rico last minute like that. In fact, it actually is an invitation-only event for now. But you can check out some of the information about it over there on the Swan site, kind of get an overview of the agenda. And we should be able to, we're working on the logistics of that now, hopefully bring you at least some, perhaps all, the audio from that event as well coming to our network. We have to get all the I's dotted and T's crossed on that first. But stay tuned to at least a few interviews from me with some of the interesting participants of the event coming soon to this network. So you guys who couldn't make it to Puerto Rico won't be left out. And you get a little bit of a taste of what happened down there. So maybe the next time, maybe next year, the Swan folks are so inclined to do this again, you guys can check it out for yourself. So stay tuned for that. I'm looking forward to it and really getting a chance to chat with a lot of these people and kind of see what's going on their side of the advisor space when it comes to options. Speaking of things that, options and the advisor space and all of the various nuances. I said variance, a bit of a Freudian slip. We're going to get to that in a second. All the various nuances that go on in the space. We talk about a lot of interesting things over here, and a lot of it breaks down on the mathematical side of the space. We try to make it penetrable for you guys at home who maybe while you're driving along or commuting to work don't feel like getting an intense breakdown on standard deviation and all things Sharpe ratio, but we try to make it fun for you guys. But Micah was nice enough to join us from Swan. As he mentioned there at the top of the show, one of his duties over there is put together some interesting white papers, some interesting studies on the use cases of options and their efficacy in various aspects and areas of the asset management space. And he has done just that with his new paper, taking an interesting spin on it. The paper itself is called Rethinking Investment Returns and How Math Impacts the Results. As the name implies there, we're going to get a little bit math heavy on this one, listeners, so stay tuned. We'll try to make it as penetrable for you as possible. But it's an interesting paper. And Micah, I can't recall seeing a paper that has this kind of focus recently, so you get pride of place for that. As I did with Randy, I'll give you the chance in your own words to give our listeners a bit of an overview of what your goals were with this paper and what some of your interesting findings and takeaways were.
Yeah, well, thanks, Mark. It was a fun kind of topic to really dive into and study, looking at how math impacts investment returns. Because, investors, one of the main things, of course, they look at and consider when they're thinking about different investments is, what is this return, and they look at the average return or the standard deviation or, Sharpe ratio, some of the things you mentioned, and that's usually a really big driver in their decision process. So the goal of the paper, and one of the reasons I wanted to really dive into this was, what are the main things that drive investment returns, and that if an investor understands them and really gets those concepts, can put on their side, so to speak, and put in their court, put in their favor to help them be more successful with their long-term returns. And so I won't get too much into like the nitty-gritty math, like you're saying, keeping it real broad level, but the four concepts that I kept coming back into that I really focus on in the paper are: one, the power of compounding returns; two, the value of avoiding large losses; the third being the impact of variance drain, which I'll explain in a little bit what that exactly means; and then fourth, the importance of the distribution of return. And these four concepts, although sometimes they might seem like basic, such as, I want compound returns in my corner, or I want to avoid large losses. It's really getting an understanding for how they impact the returns, like what the math is behind them on why a particular investment might be better than another investment, or why one equity manager might be better than another equity manager. And of course, for us looking at this, the purpose is, we use options to help structure the distribution of returns a particular way. And we believe that approach, which we also like to call hedged equity, which is where we're taking exposure to equity, but then we're using options to hedge those positions, define a risk, and risk management being the key thing that we're wanting to approach first, that the math behind these returns over time actually works in the favor of the investor in a more positive and a better way than just traditional equity management. Wall Street for decades has just kind of put forth this concept that you just need to invest your money in stocks and bonds. We believe that there's obviously more to that if you use options and use them properly, that you can actually structure equities in a way that makes them even a better core investment for a portfolio. And so just real quickly to touch on those 4 points, the power of compounding returns, of course, we're all familiar with the fact that compound returns is growth on growth, and that over time, if we're getting a good compound return, that we can have exponential growth. And that's, of course, something that we want to achieve. Everybody wants to achieve. And the following mathematical principles are the ones that really drive whether someone is able to get good compound returns. And the main one, of course, being that if the value of avoiding large losses. And of course, that's where options really comes to play with our strategy, is the fact that when we take an equity position, we also always hedge it. We're going to buy long-term leap put options near or at the money to hedge that equity position and define that risk. That helps us to avoid participating in large losses that occur within equities, like with our S&P 500 large cap strategy. So that one is kind of the key driver of a lot of these principles, is that if you can avoid large losses, there's just an incredible impact on the overall returns within a strategy. And that kind of comes to play in the third principle, the impact of variance drain. And a quick definition of that is volatility drag is another way of saying it. And that is when there is volatility in the portfolio, if everything else is equal, then that portfolio should return less. So an example would be if we have a number of portfolios that are all on average, have an arithmetic average return of 10%, with an increase in volatility. If one portfolio has 0 volatility and another one has 10, and another one has 20, each portfolio that has more volatility is actually going to have a decrease in the compound return that it ends up having. And so much so that if you have a portfolio that returns 10% and has 50% volatility, its compound return is actually over -2% annualized. Whereas if you have a portfolio, of course, with zero volatility and it's returning 10% on average, you get 10%. So that is the drain. It's the drain that occurs from volatility from the actual average return to what people, of course, are more familiar with, the compound return. And I think this principle also really applies to the use of options in the sense that we use options to help structure returns where they are less volatile, either by avoiding large losses or by taking some of the volatility out of the movement. And by taking that volatility out, we lower the drain that can occur on return. That's this variance drain. So the main point on this third principle, the impact of variance return on a portfolio, is related to the fact that averages by nature, they mask the volatility that's occurring. I kind of like the funny saying that if you take a man and his left foot is in a bucket of boiling hot water and his right foot is in freezing ice cold water, on average, he's fine. Of course, the average is masking the fact that he's not fine. It's masking what's going on. And so that's why it's important when looking at investment strategies, whether it's strategies that use options or don't use options, that you take a look at the standard deviation, the volatility, the downside deviations, another great mathematical statistic to look at, different things like that to really take a look at what's the volatility drain, the drag that's occurring by the fact that the investment I'm in has more volatility to it. So the fourth principle is the importance of distribution of return. And this one, again, goes along with the other ones in that distribution of return, we're all kind of familiar with the bell-shaped curve that kind of shows, this is what we expect return distribution to be, that it's kind of bell-shaped. And, of course, we have less occurrences on, say, major negative event that's over on the left tail or a major positive event over on the right tail. The equity markets in general are closely shaped to a bell-shaped curve, but they actually tend to go a little bit more to skewed to the left tail. So they actually have more high-risk events. That means that there's a couple more events occurring than we would expect to occur in normal distribution of returns with equity markets. And that's driven, of course, by the corrections that we've seen in equities, especially that we saw in the last 10, 15 years. And so what we try to do with our strategy, and it's because of the options that we're able to do this, is we structure the distribution of returns to be different than what the distribution of returns normally is for equities. And the way we're able to do that is, of course, through that avoidance of large losses, through that hedging of equities. It's through the market neutral component strategy that we have in selling calls and selling puts that we're able to kind of squeeze in the distribution of return, cut off the left and right tail, and squeeze those occurrences to happen more often in the middle, closer to, say, +1%, +2%, -1%, -2% return. What does that do, or what does that mean? Well, it also means less volatility. You don't have these events occurring that are +15, +10, -15, -10, and that's bringing the volatility down and, of course, helping to take advantage of all of these put together. Compound effect, avoiding large losses, variance drain, and the importance of distribution of return. So that's kind of a quick overview of these mathematical principles and from kind of a high-level view.
Well done, sir. I think there's a couple, you hit on everything pretty much in decent detail. I want to hit on a couple of things that kind of leapt out to me when I was reviewing your paper. And you listeners, you guys can find it for yourselves. By the time this show is up, it should be posted over there on the Swan Global Investment site. The paper is just called Math Matters, Rethinking Investment Returns and How Math Impacts Results. You can also just search for that title. We'll also link to it in our show notes on the website and iTunes, everywhere else. So if you're listening there, you can click on the link and you could read it for yourself. A couple of things that really caught my eye. First, you mentioned that benefit of avoiding large losses. If you could encapsulate and summarize kind of the crux, the focus of what this program has been about for pretty much since its inception, it has been pretty much around that core concept, that risk management use case of options. That really is front and center for so many of the listeners of this program. They really want to help mitigate the risk of their clients' portfolios and options. As we're clearly in the weeds here, we're clearly part of the acquire. We like options, but it's proven time and again, study after study, including your new paper, Micah, that options are one of the most, if not the most, effective ways to really do that. And just think about that. If you can mitigate a lot of those losses, like you said, if you can avoid those massive swings to the downside in particular, then you're really just ahead of the game over time. It's a very simple thing. So if you can encapsulate this program into one thing, using options to mitigate your risk, and then of course using a lot of the other things we talk about on the show on the income side to help pay for that protection. That's kind of the double side of the coin of options that we really want to get across to you guys, the listeners. And that's kind of what you guys at Swan are doing all the time there by rolling and adjusting your puts and having the near-term puts sell against it and the covered call. All of that over time used to offset some, if not all, of the cost of that protection. So being able to provide protection without nearly having to pay through the nose for it, always a good thing. And the second thing that kind of caught my eye, Micah, you had an interesting stat here in your paper. I'm just going to read this out for our listeners. You say, in reality, this gets to that variance drain point you mentioned. You said, in reality, not everyone wants an investment that grows at an average of 9.5%, like the S&P 500 since 1928. And you might say to yourself, well, why would that be? That's a great thing. Everyone wants 9.5%. But as you go on to say in your paper here, you say that 9.5% involves multiple minus 40 and to minus 80% drawdowns and sometimes decades of negative return in order to achieve it. And people leave that part out of the narrative a lot, Micah, when they're talking about the S&P. Oh yeah, it averages somewhere between 7+ to like 9+% right now. And that's kind of just it. They leave out all the other nuances and periods and, long periods of drought and no return and negative periods in that. I think that you're right. That notion of just here's the average return for the S&P over whatever period kind of leaves out a lot of the story, and that's kind of what you're hitting on here in this white paper.
Hey, Mark, I'd like to add something and just maybe reiterate what Micah just said.
Sure, go ahead.
I think the conclusion is two investments that have the same average return don't necessarily end up with the same annualized return. And I think that what we would argue is that obviously the one with the lower volatility is going to generate higher annualized returns over time. But in addition to that, one of the biggest problems we all know about the average investor is the average investor typically makes mistakes at the wrong time. That means usually selling at the low and buying at the high. They let emotion get involved. And so one of the things that we try to do and educate our clients that use our strategy is, hey, we're going to protect you, quite frankly, from yourself to make those decisions. So, you kind of look at it and say, if an investment that averages 10% per year has a lower volatility, it's not only going to outperform the underlying indice, but it's also going to outperform the individual investor who actually is 2 or 3, 4% lower than the actual indice itself because of the emotions and the bad decision making that comes into when you have to deal with the volatility swings.
A lot of interesting stuff. Like I mentioned, listeners, search for Math Matters, Rethinking Investment Returns and How Math Impacts Results. Of course, you can just find it over there at the Swan Global website, as well as, of course, via our site or through the show notes or through the podcast links or wherever else you find this fine program. Before we wrap up and move on from this paper, Micah, since this is your baby, any last little nuggets or gems you'd like to share with our listeners?
Well, I think Randy summarized it really well there. I mean, the kind of the key takeaway is, hedged equity. There's a number of ways that people can invest in equities. They can, do passive equity investing with, ETFs, or they can hire an active equity manager, or they might even hire a tactical equity manager. But hedged equity, we believe, is very different from those other three types in how it structures returns, how it lowers volatility, its consistency, its stability that's brought from the way the portfolio is structured with options. And so helping people help themselves is kind of the thing with hedged equity investing. A part of the paper, there's a section there from a Dalbar study that I think really stood out to me as I was putting it together. That the studies on the quantitative analysis of investor behavior, and on average, it shows that most investors just really underperform the market, and it's because of the fear and greed that can drive poor decision making, the emotions that can come into play as markets correct or markets suddenly take off, and having that kind of done for you by the usage of options is so much better than the people relying on their own emotions, which can sometimes cause them to either sell at the wrong time or buy at the wrong time, and that's kind of the overall, I think, argument for it. We all need to be invested in equities. Equities has been shown to be a great manner for getting growth above inflation and to achieve goals. It's the best way to get long-term growth. but it's also very volatile. It's also very dangerous in the sense of the massive sell-offs it can have. So having a way, such as our hedged equity DRS approach, that can structure returns to limit volatility, to avoid large losses, we think is the key to equity investing, and that all of that put together, all these principles put together, makes for the DRS and hedged equity to be a core component for portfolio management, not just something that you have as an alternative or as the aside. This should be something that people should be looking at instead of traditional equity management.
Well, we always love more data, more hard data on the efficacy of using options in these tests. That's why we like to have the OIC guys on the show as well, because they always bring a lot of great data. So I'm looking forward to having them back on with some of their next studies coming up. There's a lot of great studies in the world of options lately, so a lot for us to break down here on the show. Unfortunately, we have to keep moving with this segment into some of the, I think, less pleasant aspects of the options world right now. And if you're talking about what's top of mind for a lot of people in the world of advisors and options right now, it is the regulatory side. And Randy, you may recall, and a lot of our listeners may recall, we discussed this subject quite a bit last year around Q3, the middle of Q3, when the comment period ended. I can't remember in the history of this program getting more vitriolic responses in terms of people being very vehemently against this proposal when we discussed it last time. This was, of course, the Department of Labor's essentially revision to their fiduciary proposal. It gets pretty deep into the minutia of legislative initiatives here, listener. I won't bore you with that, but essentially they're revising their fiduciary proposal to change the investment landscape, change what products and what types of advisors can and can't do certain things. And in this language, they effectively, through omission, left out listed options as a tool that these fiduciaries could utilize, particularly when it comes to IRAs. Now, if you've listened to this program, you're familiar with options at all, and certainly a lot of our listeners, I'm sure, a lot of their clients utilize these products or want to use these products in their retirement accounts. They're saving for retirement. As Micah just pointed out, over the long term, these types of hedged equity approaches are pretty effective over the long term. So you want to have a long-term approach. IRAs are an ideal platform for that, and yet despite of all this, the Department of Labor proposal effectively eliminated that use case. And it seemed like when the comment period closed last September, given the overwhelming nature of the pushback against this proposal. Like I said, we had retail people writing in asking us where they could reach out to their congressmen and things. People who normally wouldn't write into a program like this or probably even listen to it were coming in and getting fired up over this notion. They're saying, what do you mean I can't use options in my retirement account? So it was really a very galvanizing issue for a lot of people, and pretty much everyone came down. Very rarely do you see such unanimity of opinion in the world of options. Usually this is a very contentious space and everyone has their own agenda. In this case, it was pretty much uniform. Everyone has been pushing against that. Our friends over at the OIC with their legislative arm have really been leading the fight on this one, taking it down to Capitol Hill time and again. It seemed like that fight was kind of won. It seemed like the last time we talked about this, people actually wrote in asking about us, what was the status on that? And as I said on this program a few months ago, I thought it seemed like the Department of Labor got the message that there was a lot of universal criticism of this. Even down in Capitol Hill, there was kind of bipartisan opposition to this. Speaker of the House, Paul Ryan, slammed it in very, very strong terms. A lot of Democrats, I believe over 100 Democrats, also getting on board the anti-proposal revolution or regulation change here. So a lot of opposition on both sides of the aisle from the industry as a whole, from a lot of the retail public. It seemed like this was a no-brainer that this was going to go away. And here we are now, end of March, which is when we're supposed to see the new regulations go through. And surprise, surprise, it's back on the table. And it does seem like perhaps the Department of Labor, despite all the vehemence to the contrary, may indeed go through with this restriction. And it's kind of baffling to me why they would do this. The House and Paul Ryan and others have already kind of vowed to step in and fight this if it does indeed come to pass. So they're pretty much picking a big fight for themselves if they do this. The industry is certainly not going to step back on this one. They're going to come in swinging for the fences because every options exchange and broker and everyone else doesn't want to lose all that volume. I've seen some studies up to 15% of ADV in the option space comes from IRA-related activity. So that's a large chunk of ADV to simply have go away. So there's a lot of interest. If you look at the comment letters on this, there's a lot of individual people writing in on their comment letters. Some weird ones in there, but many comment letters, many more than a typical proposal like this would ever see. Clearly indicating there's some strong interest in this, and it kind of just boggles my mind. And I know, Randy, we talked about this a few months ago. Like I said, it seemed like it was a done deal. It was in the rearview mirror. This was kind of just a momentary mistake on their part, and now they're going to fix it. And now, as we're coming down to the wire here, we should hear any day now what exactly the proposal entails. It seems like they may be swinging back the other way. What are your thoughts on this, Randy, as we are drawn into the fray of should options be utilized in an IRA account?
Well, I always start off, my main premise is I like investors and consumers to have choices. This clearly limits choices and potential investments for investors. So on that a blanket response, I would say I'm obviously against something like this. I really have to scratch my head, like you said, and figure out what's the motive. What are they really trying to accomplish at the end of the day? Quite frankly, it seems to me like there's some other ulterior motive that we're not really either aware of or mentioning that is the reason for this push when, like you said, both sides of the aisle seem to be against this. The industry obviously has tried to work, and try to bring some reason to this discussion. So the answer is, I don't, like I said, I scratch my head. I don't quite frankly understand the benefit of not allowing listed options when, of course, when you look at all the studies that we've seen and all the research that's being done, it's always comes down to the same thing. Listed options are a great risk management tool. They're a great enhancement to portfolios. Obviously, if you're not in a leveraged scenario. And I think that's the only thing I can really get my hand down is the government trying to protect people from their perception that people really can't take care of themselves. I can't say if there's another agenda or motive beyond that, but it hasn't been clear to me what that is.
I'm looking forward to kind of getting the pulse of some of the attendees of your conference next week to see what their thoughts are on this. I'm sure they have a lot of interesting thoughts on this because it is so top of mind, and probably by next week we probably will know what the ruling is indeed. And you're right, it is kind of weird that a governmental agency would kind of pick a fight like this, and they clearly have. They've drawn their line in the sand. It's not done deal yet, so I shouldn't say that for certain, but maybe they'll see the light of the day at the end of the day. But my hope on that is dwindling as every day goes forth. So maybe, who knows? It looks like if you're a fan of using options in your IRA, listeners, then I encourage you, again, surf on over to our friends over there at the OCC, their optionseducation.org site. There's a tab there that says News and Research and Legislative Updates. They will give you all the updates on all this stuff as it goes forward. There's also emails and places in there where you could email your congressman and tell them how you want options. You want to be able to use options in your IRA, so make your voice heard on this. A lot of you already have, but make it heard more and louder and continue to do so. Because with Randy, like Randy said, limiting choice is kind of an odd thing for a regulator to do. Obviously, they want to protect people, but when they include things like variable annuities and other things in this fiduciary proposal, which include derivatives but not listed, cleared options, it just doesn't make sense. It doesn't really seem like it seemed like it was a sin of omission, not of malevolence. And now that's starting to seem like it may not be the case. So interesting how this is going to play out. Since we're talking regulation, I'll hit on this really quickly too. We can talk regulation all day. Unfortunately, all of it seems to be negative, listeners, when it comes to recent updates in the realm of all things options. Again, I wish our friends at OCC could join us today, but they are traveling because they've been leading the charge on this one as well. The SEC, not to be left out, the SEC, the actual regulator of this space, also cracking down a bit on the use of derivatives by registered investment companies. They're making amendments to the well-known 40 Act, the Investment Company Act of 1940, to provide a more comprehensive approach for using derivatives in this by mutual funds and exchange-traded funds, closed-end funds, et cetera, and so on and so forth. But in so doing, they've kind of left out a few interesting, again, maybe sins of omission, maybe on purpose, left out a few strategies and uses that we talk about. For example, they don't They do leave out. They don't have a problem with buying options, which is a good thing because they shouldn't, because you're not writing options, you're not causing risk. But they somehow exclude covered calls from their allotment. So a lot of the people out here who like to use a covered call or two in their clients' portfolios generate a little bit of income, or in the case of the Swan strategy, to pay for some of that protection. If this SEC proposal, this amendment goes forward, that may be a difficult thing to do. There's also a lot of things that are deep in the weeds about how they treat derivatives exposure with respect to covered calls. And of course, they also kind of lump listed products in with a lot of these OTC products that we've seen for years that have really been receiving the lion's share of the scrutiny and been causing the lion's share of the problems from a derivatives are bad perspective. If you look at any of the big scandals that involve derivatives, pretty much all of them have been OTC. There's never really been a listed derivatives scandal that I can think of that involved, risk or anything like that. They're really substantial along those lines. For the possible exception maybe of Barings, but he kind of hit a lot of that stuff. So aside from that, there really haven't been any. Look at the derivative scandal that was blamed for AIG. That was all OTC. So the notion that they kind of lump listed derivatives in with OTC is again another sticking point. And just again, not to dwell too much on the negative side of the regulation, but it's kind of hard to get away from it these days. Randy, you mentioned that you're going to be hitting on a lot of regulatory initiatives and market structure things at your upcoming conference. Is any of this going to be on your radar? I imagine it's going to be kind of hard to avoid this stuff, given how it's so top of mind for so many people right now.
Well, we haven't actually set aside any type of a breakout session or session for this, but I think it will come up definitely in the Q&A. I think this affects obviously a lot of people in the investment community, so I can't imagine it won't talk. As you've probably seen, we do have a representative from the OIC at the conference. So like I said, I think that will absolutely come up, and let's just hope this thing comes down on the right side of choice.
Couldn't agree more, and we could keep going on some negative regulatory things, but let's move on to something more positive. You guys send in a lot of great questions for us here on the old program. I want to make sure we get to them. So I think without further ado, we'll allocate the rest of our time to some of your fun listener mail in our office hour segment.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody. Welcome to the office hours. Like the name implies, this is the portion of the show where you guys get to dictate the flow of the conversation. You guys send in all kinds of great questions. We only do the show once a month. I want to make sure we give you guys as much time in the spotlight as possible. Starting off with a question here from NVid. I think I'm pronouncing that right. He or she writes, "Hey, the junk bond market is melting down and interest rates are hovering around zero. Is the best place to find income these days via options writing rather than investing in fixed income or related products?" Well, we're all deep in the options choir here, Mr. or Mrs. NVid. So we all like options, but that's been my preferred vehicle for income for a long time. Is some of these strategies talked about here on the show. It could be your basic covered call. It could be, we talked about, of course, your cash secured put. You could combine the two into a wheel trade, or as our friend Mr. Kavanaugh over there at RCM likes to call it, the triple income trade. So there's a lot of different ways you could harvest your income. You can do it, of course, the way Randy and the guys do over there with the near-term put against the longer-term put, as addition to the covered call. So have a lot of different income components. You can structure it in a lot of different ways, but I've always found that to be my preferable way rather than some sort of fixed income product, because at the end of the day, options are so adjustable to your environment. People always like to look for names that have high dividend yield and dividend income. They kind of restrict their asset allocation selections to those names sometimes looking for income. With options, you don't have to do that. Options, you can create a dividend income stream on any name that you want. So if you want XYZ and you want to create an income stream on that, you can do that. That's kind of always been my approach. And we've seen this if you looked at or listened to any other programs on our network, or if you read our site, a lot of our unusual activity. You've seen some of the lengths that some of the big players have gone to over the past year with rates still pretty low to try to harvest that yield in some interesting ways, going a little bit farther out the term structure, doing a little bit more on terms of different legs to their short components and things like that, and doing interesting things to try to get more yield, because it is a challenge in this environment, obviously. But still, at the end of the day, I don't think you'll find anyone on this program. I won't put words in your mouths, but I'm assuming that anyone here is going to disagree with the notion that options are the preferable vehicle for income generation. That said, maybe you guys do disagree. Maybe we're going to have a bit of a crossfire moment here. Maybe we'll start with you, Randy. What are your thoughts here for our friend, Mr. or Mrs. NVid? He wants to know fixed income products versus options when it comes to income.
Well, clearly I'm in the boat of option income generation. That's a big component of our strategies, generated, probably close to 50% of our returns historically. But I always look at it as it relates to most of our products, not all of our products, but most of our equity markets do have an income component built into the ETF itself, the dividends that are paid. So I always look at it, to me, as more of an enhancement to what you're already getting. And so to me, allocating a big portion of your portfolio, let's say in your traditional 60-40 portfolio, allocating 40% to the fixed income when there's really virtually no yields available of any substance, doesn't really make a lot of sense. And so I would argue that's really inefficient allocation of capital, and you're really doing that more of a kind of a capital preservation. We can get into the discussion of whether or not there's any interest rate risk, but yes, going back to the concept of trying to generate income, allocating more of the portfolio to a kind of a hedged equity component of the strategy, really with the risk management built into those kind of strategies, actually allows you to allocate more to equities, which I think we'd all agree over the long haul seems to have the best return stream, notwithstanding the volatility that, of course, we think we're trying to fix with some of our hedging techniques.
And Micah, you're our guest today, so I'll give you pride of place on this one. Also, you're the man with the data. You've actually analyzed a lot of the numbers. What are your thoughts here for our listener, Mr. and Mrs. NVid, who's kind of breaking down in his own mind, going the traditional fixed income route versus, as we shall say, a little bit more creative route using options for income?
Yeah, I think right now it's a really important time to be looking at other alternatives, such as options for income instead of fixed income. I mean, right now there's just kind of a race to negative interest rates around the world. It's just been going on. It's pretty crazy, but over $7 trillion around the world in government bonds is now at a negative yield. I mean, think about that number. That's pretty crazy. And then if you look at by each country, I've seen some great matrices that show how many of these countries now have negative yields, either on one time frame or going into others. I mean, in the case of Switzerland, negative yields, I believe, past the 20-year now. And there's other countries that are past the 5 and the 10 and negative yields. And of course, the U.S. is not quite there, thankfully, yet. But the 10-year at about 1.82% as of today, that's not exactly a whole lot to write home about, especially as Randy just said, in a 60-40 portfolio. We just recently did some analysis, crunching the numbers to say, well, what if you have a 60-40 portfolio and there's only a 2% return that you're probably going to get, that's a little bit higher than what the 10-year is actually at right now. So you'd have to be stretching a little bit to get to 2% right now past that. But what would you need on the 60% on the equity side in order to get, say, a return of 8%? Well, you'd have to get 12% from the equity side on the 60 side if you only get 2% on your bonds, on your fixed income side. And so the risk that's occurring is people are really chasing after yield in other ways, is they're increasing the amount of risk that they're taking and looking at fixed income, either trying to get into different things like high yields and other things, going out around the world to some of these other places where the risk is a little bit higher in order for them to have just a little bit of yield from that portion. So looking at something like options is a really good idea right now because of the risk that's there in the fixed income, I believe.
All right, good question, Mr. and Mrs. NVid. I think we got time for one more here. This looks like a pretty in-depth one, so hopefully we can get to all of it. This comes from Boz431. He or she writes, hey, a client recently contacted me regarding the concept of pin risk in conjunction with options. I was unfamiliar with the term, so I turned to the experts. Can you explain what this risk is and where it occurs? Is this something that I need to take into consideration with my clients? FYI, the vast majority of my options positions are call overwrites in broad equity ETFs like SPY. Thank you for your highly informative program. It's now on regular rotation on my iPhone, along with Options Bootcamp and the Options News Rundown. Well, thank you for that, Mr. and Mrs. Bass 431. You have excellent taste in your options listening choices. Pin risk, yeah, this is an interesting one. We get this question, seems like quarterly or so around earnings time, usually when it comes in. Don't get it in relation to SPY that often. This is effectively, the notion usually comes into play when you have short options positions, as you do with your covered call positions, excuse me. And as you're selling these options, of course, let's say in this proverbial scenario, the SPY closes out an expiration exactly on your strike. Well, then it's called pinned. That's the moment where it's pinned right to your strike. And now the question becomes, what happens now? You're short this, so you don't know. There's no automatic exercise taking place, so you can't really assume that you're going to be assigned on it. You may get assigned on all. You may get assigned on none. So you don't really know what your position is going to be coming in the following morning on the open, which is usually after the weekend on Monday morning. So what we used to do, back in the day, particularly when the automatic exercise thresholds were a little bit wider, a nickel or more. Now they're a penny, so that's made pin risk a little bit easier to manage. But still, that notion is still there. There's still that uncertainty, which always equates to risk. And so what we used to do is obviously hedge half of it, and then you'd see how that would work out. Of course, in that scenario, you've put on half the position's worth of risk. If you get assigned on none of it, it's still an issue. For you, not as much because you're trading covered calls, so you have the underlying components with you. But still, if you're concerned about pin risk, I've always counseled this. There's a simple way to avoid it, and that is to close out any short positions prior to expiration. You don't have to worry about any of this. So don't deal with this if you don't have to. Again, you have covered calls, so it's not as big of a deal for you, and you're doing it in SPY, so it's not that big of a deal out there in terms of your calls are going to go away and you're left with nothing. Like a cash settled product or something like that. But still, if you are concerned about pin risk, again, not that big of a deal for you, these positions you're trading. But in general, anyone out there who's concerned about pin risk, get to the middle or end of expiration Fridays, these options are trading for a penny, a couple of cents. Just close them out, and then you don't have to worry about any of those perhaps unintended consequences, any unintended risks. It's not worth a penny or two. Just close it out, and you can sleep well over the weekend. Micah or Randy, anything to add on this popular concept of pin risk?
Sure. Yeah, I'll add something, Mark. I think, Mark, you're exactly right the way you just described it. In the case that they're asking here with covered calls, I believe there does exist obviously some pin risk, especially on some of the more liquid, frequently traded, popular options out there. You'll kind of see it happen. The institutions are kind of pinning them to the particular strike, and the best way to avoid that is just to not hold expiration. That's how we avoid dealing with any pin risk at Swan. We don't hold any options to expiration. So I think for this particular person, if you're trading covered calls, if you're concerned about the pin risk as you're getting closer to expiration, then don't hold on, like you said, Mark, for a couple pennies. Just go ahead and close it out, and you'll sleep better and don't have to worry about that.
The other side we do see, not really pin risk related, but call exercise related and assignment related, is people forget on SPY that there is that dividend. And so it comes about every quarter or so, and people forget about that. And sometimes short call positions they have are suddenly assigned against them. They're not really, they don't really expect it, or they're unsure. So just make sure you remember that one. Factor that into all your call overwrites there in SPY land. Once in a while, you get an unexpected assignment. It could be, usually that's a good thing. It's not a bad thing. But if you're not expecting it, you're looking for it. It could be a bit of a surprise and a bit of an unknown risk, unknown variable in your portfolio. So stay tuned to that when that dividend rolls around. Everyone always forgets that, and we get email all the time. Why is this happening? So just wanted to throw that out there to save myself a few emails later. But yeah, pin risk, as everyone who's been around the space for a while knows, you just close it out. You're pretty much insured against that risk at that point. And that's pretty much all the time we have for the questions at this point. But before we go, as always, let me check back in with the boys over there at Swan Global, as they're getting down to the wire now, just a few days ahead of the big Swan Global CIO Conference I'm looking forward to checking that out. Randy, we did kind of an overview at the top of the show. Anything else you want to leave our listeners with regarding the conference or indeed any upcoming other initiatives over there at Swan before we close out? Go for it, sir. The floor is yours.
Sure. Well, I guess I'd like to say is that the next show that we do, I know we're going to expect on recording some stuff down in at the conference. So we'll kind of tell people what we have available. I think there's going to be some recording of stuff that we may do with your show, as well as some videos of different parts of the conference, and probably kind of a summary of all our positions. So from my perspective, there should be a lot of good stuff that comes out of this conference that we would love to share with potential investors.
Yeah, I think we should have the next episode of this show actually up pretty soon, because we're going to be recording it at the conference next week, kind of getting our take on the conference and some of the panels and the speakers and the events and the topics that were brought up at the event. So I'm looking forward to that. And before we go, Micah, since you were kind enough to join us here on the program today, you did a nice in-depth rundown of your paper. Look for that coming soon, listeners. Any other research, any other topics you're working on, Micah, that might be interesting to our listeners that are coming down the pike?
Yeah, we've got a few. One that's going to be coming up pretty soon. There's actually a white paper we did about a year and a half ago on asset allocation study, which was a study looking at a lot of the popular asset allocation strategies that are out there. A lot of the ones that drive, say, some of the robo-advisors. It's becoming pretty popular. The portfolio management that drives those. So we did a long-term study across all these different asset allocation portfolios, and so we're going to be updating that study through the end of last year. And making some new additions to that particular study. So we hope to kind of have that right around the pike. And then a couple other things that we've got in the cooker that we'll be working on. We've got one. We're going to be having a study done on behavioral biases and how they impact investors. Basically, looking at all the different types of behavioral biases that can sometimes impact negatively or positively people's investment decisions. And I think that'll be an interesting study in helping people and either with their investing emotions and decisions, or just in general on how they view investments. And another one that we're looking at doing pretty shortly is actually kind of an overview of a lot of these great studies on options that OCC has a number of them. And we're kind of wanting to put together an overview, because there's so many great studies that are coming out, like you mentioned earlier, that the OCC or other people have put out related to options. And so we just kind of want to provide a resource for people to say, hey, here's, a half a dozen or a dozen, who knows how many we'll have there, but the studies that people can look at to learn more about options. And we think kind of giving that overview will help make those more aware to those of us that are not familiar with them, and those that are looking at our information and papers that we have coming out of Swan. So that's just a quick sneak peek.
It's actually a great idea. You're right. There's so much coming out right now from the option-specific study realm that I think a study of the studies or a comprehensive overview of the studies, I think would serve a lot of people well, because there's just coming out of, I came from the CBOE RMC conference about a month ago, and there's so much great data coming out of that. You're right, our friends over there at OCC, and I should give them their plug as well. They couldn't join us today, but again, surf on over to optionseducation.org, where our friends over there at the Options Industry Council really do a lot of great work on your behalf to advocate on behalf of options, and of course to educate people, retail and advisors, on the use cases for these products. So if you want to learn more about any of these regulatory initiatives that we talked about earlier in the show, or if you want to check out some of the studies that Micah mentioned, as well as some of the new ones they have coming out, or maybe register for one of their educational seminars or webinars that they have coming out, or check out the podcast that they do with us here, Wide World of Options Radio. A lot of things you can do to surf on over to optionseducation.org and click on the tab. There's a whole tab, actually, Options for Advisors there. So you click on that. You have to log in. You have to create a login. But once you do that, you get access to a lot of their in-depth advisor-oriented research, which is really useful stuff. Collars, covered combos, all kinds of interesting strategies, and their efficacy across a broad range of underlying, which I think is really, really helpful for a lot of asset managers out there when they're looking to sit down with clients. It's helpful to be armed with data, and they have that data for you. Check it out, optionseducation.org, to learn more. And on behalf of the friends at the OIC, as well as Randy and Micah over there in the land of Swan Global Investments, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course for sending in such great questions. Keep them coming, and we'll see you next time for more of The Advisor's Option.
The The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.